Time for another edition of Living Akamai, and today Kei Mukaigawa is back to chat with one of her favorite tax experts.
Aloha everyone, and welcome to another edition of Living Akamai. Today we're fortunate to have Troy Wada with Impact Wealth Solutions here to help us get smarter. Welcome, Troy.
Thanks, Kay.
You know, we have clients who are retired, they own their own property, and yet they complain that they're paying more taxes now than when they were retired. Any thoughts on that?
You know, Kay, a lot of people don't understand this term called depreciation. And many times when real estate investors have owned properties for about 28 years or longer, they actually lose this tax benefit called depreciation. What that ultimately means is that they end up paying more taxes on the rental income that they're currently collecting because they don't have this tax benefit to offset some of the taxes owed on that income. Now, to compound that problem, what ends up happening is when they realize either I'm tired of being a landlord, I don't want to deal with the maintenance upkeep of the property, and maybe I just want to sell it, and pay those taxes. What they find out after talking to the CPA is that, wow, I have this other problem called capital gains tax, which is enormous, and it might not make sense to sell the property. They kind of end up feeling stuck, right, and having to own this property.
You know, it truly is a compound effect. I mean, you know, they lose the depreciation. They are worried about being a landlord, and then they can't afford to sell the property. I mean, it just becomes something that they get inundated with. You know, and I know that there are other things that real estate owners face and, tips that you can provide. Anything else that you can share about that?
Sure, and we don't want to make it sound like real estate is not a great investment. We're fortunate that we live in Hawaii, and Hawaii real estate is usually an incredible investment. But what most uninformed people do is they tend to give away this real estate to their children when they're alive. What they don't understand is this concept called the step-up in cost basis. And if we use this example where someone bought a property in 1970 for $50,000, and fast forward today, it's worth about $1 million. If they sold that property and didn't do something like a 1031 exchange, they'd be paying a little over $300,000 in taxes on that sale. If the client just transferred the ownership to their beneficiaries when they were alive, they're just passing that tax bill to their children. So what most people should do is actually keep this real estate in their name or in their trust until they pass. What their beneficiaries would do is they'd perform this thing called a date of death appraisal, and on the day that they died, let's say the property was worth $1 million. The kids turn around and sold it for exactly $1 million. There'd be no capital gains, therefore there'd be no capital gains tax.
I mean, two great tips so far. You talked about depreciation and saving money on that, and the fact that you can use the stepped up in cost basis so that they can avoid paying taxes, right? There are vehicles that you can use to specialize in doing these 1031 exchanges, and that's your area of expertise. Tell us a little bit more about the Delaware Statutory Trust.
Would love to. So the Delaware Statutory Trust for this select group of investors that meet this criteria called an accredited investor, which basically means they have $1 million of net worth minus their primary residence, has made $250,000 if they're single for the last 2 years and intend to make the same this year, or if they're married, they've made $300,000 in the last 2 years and intend to make the same this year. They're fortunate enough they can invest into this thing called a Delaware Statutory Trust, or a DST. What a DST is a way for 500 accredited investors to pool their money together with the intent to buy like-kind property while utilizing the 1031 exchange tax code. That allows them to 1031 into and out of these kinds of programs, and because the property is managed by the sponsor company, it ultimately lets the landlord be hands-off out of the day-to-day management of the property. And like you say, simplify your life or live Akamai.
That's great information, and as always, we advise all of our viewers to consult with their tax professionals about their personal situation. We're also having an upcoming event where we will be having a tax professional and Troy talk more about taxes, real estate, charitable plan giving, and other smart tips. If you'd like to attend our next event, give us a call at 808-725-2000. Thank you for joining us, and let Engel & Volkers Honolulu help you live Akamai.
All right, great information, good stuff, and totally appropriate as tax season is upon us.
Yeah, and always good to know, especially, I think some people think that it's a smarter move to transfer it earlier or this or that. So these are things that everyone should know. So just to go and learn more, again, they are free seminars. So make sure you head on over, and we'll have all the details on our website, kh12.com.